All right, everyone, welcome back to another episode of On the Margin. Today, I'm joined by the Matt Levine of crypto, the one and only newsletter writer extraordinaire, Byron Gilliam. Byron, welcome to the show.
Thanks, Mike. Just for the record, I'm the only person that calls myself the Matt Levine of crypto. And I think it tells you something about the year that we've had, that Matt Levine himself has spent so much time talking about crypto that he is definitely, Matt Levine is definitely the Matt Levine of crypto.
Well, I think I go through life basically hoping one day to just be referenced as the poor man's Matt Levine, and I think you've already achieved that title. So it's a huge feather in your cap, Byron. So
I'll take it. I'll definitely take it.
Yeah. All right. So look, we're recording this on December 19th. I think it's a pretty appropriate way to start this conversation by just doing a bit of a retrospective on the year, right? It's been a pretty record year in terms of poor performance, both for stocks and bonds. For those of you who don't know, Byron is actually an equities trader for the vast majority of his career before leveling up into Blockworks. So, Byron, you've seen a whole bunch of different market conditions. I mean, what do you make of everything this year? To just set that question very broadly to you.
Yeah, I mean, I think. Okay, here's the most insightful thing that I'll probably ever say, which is that the stock market hit its all-time high on the first trading day of this year, which I look back and I think has never happened before. So all of the statistics about like this is the worst year since whatever. Most of those I think are largely just because the market peaked right on the first day of the year. So all of the year to date statistics are just completely skewed. So if I think about it just like anecdotally, this is nothing like as bad as 2001 or 2008-9. Or 2020, like everybody can remember 2020. So as far as bear markets go, like this was not a bad one. It was only in bear market territory. Like we were only down more than 20% in the S&P for like 4 weeks or something like that. Like it only even barely qualifies as a bear market in equities. It was worse in bonds. But bonds too, and bonds didn't peak exactly on the first day of the year, but the two-year yield was like 70 bips or something on January 2nd. So it did not seem like a bad year to me, for one thing, and it's kind of surprising that it feels that way because the Fed, it was the fastest rate hike cycle in history. Like Fed funds I think was 0% in January still.
Mm-hmm.
And we had inflation peaked at 9% at one point, and if you told me those two things on January 2nd, I would have expected markets to have been a lot worse than they were.
Well, one of the interesting facets of how markets have performed this year, right, is the S&P. I think year to date is down something like 19%, and TLT, which is the long bond, essentially is down about 25%. So I think one of the things that's caused a little bit of pain and what people might not have necessarily seen coming this year is both of those assets falling at the same time, and when historically bonds are a hedge for stocks. So if you've been sitting in either 60-40, right, on sort of the more retail side of things, or if you've been running some sort of version of risk parity, which is basically, the criticism is it's a levered bond portfolio, then this has been a pretty painful year for you. What do you think about those two? Anything to point out about this kind of idea that 60-40 is dead, or both of these assets falling at the same time?
Well, hopefully 60-40 will be back now that you can get a reasonable yield on your bonds. Like for my personal portfolio, I bought bonds this year for the first time since like 2009. I mean, like government bonds. I like, if you came into this year long government bonds, I feel like you weren't totally paying attention because you just were not getting any. I mean, that's unfair. A lot of people did. I mean, people were buying that Austrian 100-year bond. Have you looked at that? It was, I think it was issued at par with a 0% yield, I think, and it's trading at like 6 now. It's gone from 100 to 6, I think. So that's unfair that people were long bonds for whatever reason. But I think hopefully this, that was the anomaly really, and it seems like now we're more normalized where you can get at least a little bit of yield on your bonds.
I think when you're trying to formulate some sort of framework for how assets are going to perform moving forward, you have to be thinking somewhat about inflation there. So if I had to kind of divide the world into two camps, I'd love to know where you fall on this spectrum, which is, okay, the Fed is back in control. They care about price stability again, and they're going to basically continue raising rates until Fed funds is consistently above inflation, and we're going to take a huge bout of deflation. It's going to be a bear market for a couple of years, but we're going to sort of take our medicine, and the Fed has the wherewithal and the tools at their disposal to do that. Then on the other hand, there's kind of this idea that inflation, if you look at it historically, it is notoriously sticky to to stamp out, right? Typically, what you get in, at least in the 1940s or the 1970s in the US, you get sort of this stop start inflation where we think everything is going to be fine and inflation heads back to the Fed's target, but then we haven't really stamped out the inflationary impulse and then it kind of rockets back up again. Where on those two spectrums of Fed's going to fight this effectively and we're going to get deflation versus we've got this kind of potentially secular, very sticky inflation, like where do you sort of fit on that spectrum?
Yeah, I'm more worried about the downside. I feel like the long term trends are still deflationary, um, and yeah, I just worried that we're gonna overshoot on the downside. But that's like, yeah, I have no reasonable track record in predicting these like giant structural things. These are things that people are going to have to write doctoral theses about in 10 years after the fact. People are still arguing about the 70s inflation. Like people, the academics are still arguing about what caused and what ended the 1970s inflation boom bust. So the idea of like predicting the next 10 years of inflation is really an active hubris, I think. So I'm not particularly going to try. But just if I had to pick a side, I would be more worried about deflation. On the other hand, I mean, I could definitely see the other side of the argument. Like, there's going to be a lot of the structural stuff in the other directions as well, like reshoring. And I was just reading about TSMC building a new fab in Arizona, which has got they're building people are building fabs in places for non-economic reasons, which is which is inflationary. So I can see the other side of the argument, but just instinctively, I'm more worried about the downside.
Yeah, it's not looking like a particularly good year. It's funny, we've been this entire year, we're talking about, negative, but not ultimately drastically bad performance in the stock market. And there's been this sort of ongoing debate of, are we in a recession? Or most indicators are pointing yes. And some people are firmly, they don't even want to have the conversation. Yes, this is 100% a recession, but 2023 certainly is looking like there are at the very least headwinds, to say the least. And I was reading some of your newsletters from this past week to prepare for this conversation, and one thing that I've talked about on this show, and that you also talked about in your newsletters last week, was one other shoe to drop being earnings. We've most of the depression that we've seen in the stock market basically has been a revaluation, right? And that's why the Nasdaq has done worse than the S&P, right? Because that's more interest rate sensitive. It's very, earnings that are very far into the future. But what we haven't really seen, honestly, earnings have held up and expectations of earnings have held up pretty strongly going into 2023. Do you expect that to continue, or do you think earnings is the next shoe to drop, so to speak?
Um, yeah, I don't know if I'm kind of in the soft landing camp for now. I
Mm,
think just because we're coming from such a high level, there's still a lot of stimulus money around. Corporate margins are still really high. There's still pent up demand for things, and also, inflation is a tailwind for corporate earnings. Earnings are nominal, right? And nominal
yeah.
numbers are going up with inflation. So again, this is just a total guess. My base case is that we're gonna either have a soft landing or a pretty mild recession. It doesn't, an earnings recession. And so I think corporate earnings will be less bad than people think they are going to be. But that's the main question. How soft is the landing going to be is going to be the question for 2023.
Mm. I think it's an interesting point as well to just talk about liquidity. I mean, Powell is very focused on even his language, right? In Fed minutes and that sort of thing. He's very focused on the cost of money and the hiking of interest rates. Whereas I think you could make a pretty strong argument that the quantity of money, the amount of money, so that number on the Fed's balance sheet is actually maybe the more important thing. Maybe this is my sort of beginner's brain, outside mind for many things in finance, but always been a little unclear to me. They've got these two very powerful tools when they're talking about monetary accommodation. One is the price of money, one is the amount. I've never been able to really put together a good thesis on which one is ultimately more valuable or important. If I was sort of approaching the problem almost from a 5-year-old's perspective, I would say the amount of money, because the amount of money is the denominator, which seems a lot more important than the marginal cost of financing a project, right? This is like how it works in the macro textbook. The marginal cost of financing a project at 5% versus 7%, or I'm just not sure that that moves the needle quite as much as changing the whole denominator of how assets work. But I don't know if you have a more nuanced opinion than I do there.
Yeah, I mean, I think there's two things. There's a quantity of money and the velocity of money, right? And I think, longer term, that's the quantity of money that counts, like,
Mm.
how many dollars are chasing how many goods. And then in the shorter term, the velocity of money counts as well, but that is more volatile. Um, um, so yeah, I guess my other thought on that is that, you know, everyone was talking about QT is coming until QT started, and then like I've hardly heard a peep about it since, right? Like
Yeah.
which is kind of funny, right? Like you don't people we spend all of our time guessing whether Fed funds is going to be like 25 bips this way or 25 bips that way, and meanwhile the Fed is doing whatever 90 billion a month of QT or something like that. I don't even know because nobody ever talks about it, so
Yeah.
it's really hard to say like how that change in liquidity is affecting things.
Mm.
It seems like it's they're not affecting them that much, or certainly not as much as people said they were going to. But I don't know. It's really hard to quantify.
I'd love to get your thoughts. You wrote actually a great piece a little while ago called "In Defense of Arthur Burns." Just while we're still on this topic of inflation, so can you give us just sort of the high level overview of what that newsletter said?
Yeah, so the standard narrative obviously is that Arthur Burns, the Fed chair in the 1970s, was hopelessly behind the curve on interest rates, and as a result, never got inflation under control. And then Volcker came in, was a hardliner, took interest rates to 19% or whatever it was,
Mm.
and that's what ended the inflation cycle that seemed otherwise intractable. Um, but there's been a lot of revisionist history on that, and I'm a total sucker for revisionist history, so I can't and contrarian takes. Revisionist history and contrarian takes are like my two favorite things. So I couldn't resist agreeing with this. But there's a school of thought that what actually killed the 1970s inflation was essentially the price of oil. There was a glut of oil that hit in like 1979 or something like that, or in the very early 80s, and that was the real reason why inflation ended, and not Volcker's rate hikes. And you could make the argument that Arthur Burns gets some credit for that, because by keeping interest rates lower than you would otherwise expect them to be, that encouraged the investment in oil infrastructure, that encouraged the supply response to the spike in oil prices, and the response, the investment that that oil producers made in the 1970s created that oil glut, and that's what ended inflation. Um, you know, there are doctoral theses about this, so who knows if that's really the real story. But I think it's relevant to today, because we all want the Fed to kill inflation by raising interest rates. But to the extent that this spate of inflation is supply driven, supply side issues, which clearly a lot of it is, half of it is maybe, I think seems like the best estimate. Higher interest rates discourage investment, and the only real way to fix supply side inflation is with a supply response, which requires investment.
I'm going to actually push back on you and say I'm still more worried uh, about inflation than deflation. I'd love to get your thoughts on sort of my high level thinking and argument here. But I think the reasons why I'm still a little bit worried about sticky or persistent inflation is, one, when you establish these sort of secular trends, inflation is a very psychological thing, and that's not a very satisfying answer to a lot of people. But I haven't really, just in anecdotally my dealings with people living in New York or my friends and things like that, this idea of like crazy wage gains has still been, cemented in a lot of people's heads, and people think that's right. And that's a very difficult thing to sort of stamp out. I think one of the biggest, people talk a lot about demographics. I sort of, maybe a slightly more, the way that the variable that I think is a little bit more important when it comes to inflation is the ability to borrow from low cost labor pools. And I just think the ability to do that is going to be drastically lower moving forward in the future, because ultimately employers are going to have um, much less ability to do that with geopolitical tensions. And then I kind of sense this shift. Capital has been, there's always this push pull, right, in between capital and labor. And I sort of think capital has been trouncing labor for the past X many years. And I think labor, there's something about inflation that's kind of a political decision. And if you look at the way that our government kind of talks about, uh, where I think our government falls on on those two sides, I think it's going to start favoring labor over capital. So I kind of see these enormous tailwinds for things that produce inflation, and maybe we'll kind of get this stop start dynamic where successfully the Fed will try to get up and say, hey, like we're gonna fight this, but ultimately in the back of their minds, I also sort of think, hey, we've got this pile of debt and we got to take care of that somehow, and inflation is probably the easiest way to do that. So those are sort of all the pro inflation arguments. I'd be curious if you have any responses, or tell me that I'm thinking about things incorrectly.
I don't know. I guess my first thought is that labor v capital is kind of a 20th century heuristic, it seems like to
Mm,
me. Um, I think the 21st century is going to be more about AI and stuff.
mm.
Radical productivity gains that we maybe can't totally imagine right now, and this could be one of the catalysts. You know, Forcing employers to invest in AI and factory automation and machine learning and whatever, to deal with shortages of labor. Instead of just hiring people, they're going to have to invest in new technologies and stuff, and that can ultimately be a positive thing. I mean, Japan has had a later labor shortage for I don't know how long, right? And they don't have any inflation. Um, and I just don't think that I don't think labor has the leverage that it would have done in the middle of the 20th century when it was more of an issue. It also makes me think of the Yuval Harari um, thesis that a lot of the reasons the sort of populist backlash that we've seen over the last few years. One part of that was that that labor is getting the sense that they are going to be irrelevant relatively soon. That we're all gonna we're all going to lose our leverage with employers because we're all going to be replaced by AI and stuff like that. And I think that's a little bit. That's a little bit high level, but I think that's probably going to be more of the thing in the 21st century than it was in the 20th century.
There's certainly one future where leaders in America, maybe corporate leaders and also political leaders, sort of learn the lesson that maybe society wouldn't hope that they ultimately learn. Right? There's one case where it's like, yeah, maybe actually capital's been getting the better side of it than labor for a long period of time, and it's finally time for labor to have its day. That's almost like an underdog story that I think a lot of people would want to believe. And America's going to see wage gains just like it did back in the 50s, 60s, 70s, whatever it was, and everything's going to normalize that way. But I can also see it maybe cynical glasses here, cynical take is that actually employers say, wow, we do not want to, we haven't had to pay, especially on the lower side, the most low income earners in America, we haven't had to pay fair wages in a long period of time. This is ridiculous. We're not going back to this. Now it's time to invest in AI. And certainly seeing things like ChatGPT, I got to be honest, that is a pretty remarkable piece of technology. It's certainly not at a place where it's going to replace, content workers or
Not going
writers
to
or
replace
creative.
newsletter writers anytime soon.
That is for sure, Byron. That is for sure. But I mean, it does seem like wow. You could imagine with a couple more iterations of this technology that there were certainly some job fields that you thought were going to be the domain of humans and creativity, and I don't know. It sort of does call that all into question.
But you could also say the same thing about typewriters replacing scribes and automobiles replacing horses and things like that. It'll just create all kinds of new jobs, right?
Well, you could almost imagine as well that maybe 10 years from now, instead of you and I sitting down and having this conversation between the two of us, really what we do is you and I sit down privately for 30 minutes and feed the right inputs into Chat GBT 10.0, right? And actually Chat GBT spits this thing out that's looks like you and I talking, but it's really AI, and it distills the best part of our, our thoughts, makes us both sound smarter and look better, which, I'm actually okay with. That'll be a fine outcome for the feature. I would love to get your thoughts. There have been some pretty stark statements from some pretty large investors this year. And these are guys that you typically wouldn't want to fade, right? So there are a couple quotes from guys like, Stan Druckenmiller. We're talking about stocks, but like here are two quotes. It's going to sound like I'm determined to get you to say some pessimistic stuff here, but like you tell me, right? So Jim Chanos, right? This is a quote. If this was a bottom, it would be the most expensive bottom in modern financial history. And what he's talking about there is price to earnings on the S&P 500. Typically when there's a bottom, it resets. I forget the actual statistics, but it's about 50% lower than it is currently. And then Stan Druckenmiller has this quote where there's a high probability, quote, that the stock market will be flat for an entire decade. And he's also sort of referencing, basically the 70s. So I'd be very curious, when you hear these guys say these things, obviously there's some amount of maybe media savvy that's going on there, right? And they kind of understand the headlines that they're trying to generate. But I don't think Stan Druckenmiller he's a pretty solid investor and generally says stuff he means. So when you hear guys say stuff like that, does it make you change your viewpoint at all? Do you think there's a chance that the stock market could be flat for the next decade, or what do you think? When you hear those sorts of statements,
could be, definitely could be. I think out of the two, the first one about it would be like the most expensive bottom or whatever. Yeah, it could be. Excuse me. But this is like, it's a genuinely unique scenario. Like, what is the sample size on, bear markets after pandemics with a war in the Ukraine and 9% inflation? It's a sample size of 0. So could this, could this time be different? Yeah. Every single time is different. Like, that's one thing I've learned in my trading career is that, people always laugh at the "this time is different" thing. It's different every single time, So I don't think history is any great guide on what's going to happen in the future. Unfortunately, as a history major in college, I wish that it was more of a guide, but I don't think it is. Could the market be unchanged for 10 years? That would really surprise me. Again, because stock prices and earnings are denominated in nominal dollars. So it's kind of hard to be unchanged for 10 years unless you start at just a really high level of valuation. And I think valuation is full, but I don't think it's crazy. It's not like NASDAQ in 2001 or something like that. So yeah, I would be really surprised if equities were unchanged over the next 10 years.
Are there any pockets of equities like within the broader stock market? I mean, maybe if you even just had to, however you want to slice this, just in terms of specific sectors, or you just want to say value versus growth, which has basically become sort of industrials versus tech, or it kind of seemed like there was a period of time where people were, the stock market was doing very well right after COVID. And everyone was like, why is the stock market doing so well when the economy is getting absolutely trounced here with these crazy negative GDP prints? And the answer kind of ultimately ended up being, if you look at the composition of the NASDAQ and the S&P, especially just take the S&P, it's mostly tech stocks, right? With Apple being an enormously outsized component. So when you were lowering interest rates, those stocks that were a huge portion of the S&P index were doing particularly well. Now it almost seems like there's this shift, under and tech stocks are getting hammered, but you also see sectors that have been beaten down for the last 5 years, like energy, outperforming and doing extremely well, and they're sort of making up for the loss in performance of the tech sector. So I'm curious if you have any opinions on like any that sort of rotation, or if there are any parts of the stock market where you're like, this is actually maybe an interesting spot of opportunity.
It feels like the market is going to be less sector and factor driven going forward. It's going to be less momentum versus value and more bottom upish, which would be a good thing. It'd be great for stock pickers and active managers and stuff like that. Like Apple and Microsoft seem really expensive to me. Google and Facebook seem pretty cheap to me. And that to me is more interesting than just buy tech or just buy value. So I don't have any real prediction on which is going to win out. But when I just poke around in the stock market there, I seem to come across a lot of things that seem really cheap. Like home builders seem really cheap. Google seems really cheap. So I think there's going to be plenty of opportunity, and it'll probably be more bottom up and less top down than it has been previously.
Let's talk about this has been let's talk about your experience this past year in crypto. So you joined Blockworks at a very interesting time, right? You kind of saw the tail end of a bull market, and now into its first bona fide bear market, actually, where things have been sort of down only. And there's been, very well detailed on this podcast and in your newsletter, but the collapse primarily in, it looks like the vector that crypto is super vulnerable in actually was the vector that, all financial infrastructure is vulnerable in, which is just CeFi and leverage, right? And there was this sort of hidden systemic leverage. Also, there was an enormous alleged fraud in the form of FTX. That's all being litigated, sort of as we're recording and speaking. But I'd be curious to just sort of get your view on how you're feeling about all things crypto right now.
That's
Are you positive?
Question.
Are you bearish? Yeah, tell me how you're feeling.
I feel pretty good about it. Just for a personal reason is that I'm like the biggest victim sucker for FOMO. When I started in it and things were like doubling and tripling and quadrupling, I was always like, I hated just missing out on all of this stuff. So I'm like personally much more comfortable in a bear market because I don't feel like I'm missing anything, which is great. In terms of big picture, I also think that it's ultimately going to be a good thing for crypto because there was, one of my major takeaways for this year is that there was just way too much money sloshing around in crypto, and it was counterproductive, like extremely counterproductive. It led to just a lot of bad things with Ponzi's and scams and fraud. And I think there'll be a lot less of that because there's a lot less money sloshing around now. And people are going to, the capital is going to have to be allocated a lot more smartly and a lot more productively. And that should hopefully, over the course of a couple or a few years, that should have, produce better outcomes than what we were producing at the beginning of this year. So in that sense, I'm positive on it. And then in another sense, I haven't really changed my view very much, which is that I still think that crypto is not going to be great for investors, even at these much lower prices, but that it is going to, create a lot of great things for users. And I think that would be a really good outcome if that's correct.
Can you, for listeners who might not be familiar with that thesis of yours, can you unpack why is crypto not going to be good for investors?
I'm just skeptical of it as an asset class. For a bunch of reasons, one, it's open source software, so it doesn't really lend itself to moats. A lot of stock market investing is buying a stock that has a moat and then can just extract rent from behind its moat for years and years and years and decades. And that is, crypto does not seem to lend itself to that, which is great. That's a good thing. We don't like rent extraction. Rent extraction is bad. For another thing, the uh, the revenues in crypto are all denominated in crypto, which makes it very hard to value them. Like if you try to put that in a DCF, you get a circular error. You're trying to determine the thing that you're trying to forecast the thing that is also your input, which is impossible. Um, and then also, I just think that they are, cryptos are not really assets in the sense that we understand equities and things to be assets, because they're not anybody's liability, right? There's no legal liability when you buy a crypto token. You don't have a claim on assets. You don't have a claim on cash flows. It's not an asset in the sense that we understand them from traditional finance. So I kind of have a hard time ascribing value to them.
I think those are all super valid points. I also just realized that your dog is in the background right over your shoulder, and I got a little distracted looking at your dog there. Very cute. Okay, so let's address some of those claims, because I agree with a lot of them actually, but I do have some pushback to a couple. So let's talk about the idea that this is crypto's open source software, and I think on the one hand, my own thoughts are sort of divided on this subject, because in one sense, I think there's kind of this narrative of crypto is a good way to monetize open source software, which has traditionally been extremely valuable, but very difficult to generate revenue and capture economic value. So you look at something like Wikipedia. How much value is there? I don't know. I use it every single day. I love Wikipedia. Actually, sometimes on weekends, I will literally just allow myself to go down Wikipedia rabbit holes for like 3 or 4 hours at a time. And it's a huge source of pleasure for me. Honestly, it's basically entertainment. But how much money does it generate? Not an enormous amount. It's sort of like a public good. And I take your point that from an investing standpoint, that really a great thing to invest in. I do think though that if you actually, because the whole idea there is that you can fork different crypto protocols, right? So as soon as you start to sniff out this idea of rent extraction, then ultimately what you're just going to do is fork it to a new chain. It's going to be great for users, but the flip side of that, it's going to be very poor for investors. I think that's true for some parts of crypto, but I don't think every protocol is just as forkable as others. There are parts of protocols that make it very difficult to frankly fork. Like if you look at something like Ethereum at this point, I find it very difficult to imagine a world where there's a significant hard fork where the value really ends up getting divided. Even if you look at previous hard forks of something like Bitcoin, I think what you generally find is that it's almost like a good check and balance. The fork ultimately is like a pretty good check and balance to make sure that ultimately the right people and stakeholders are making decisions for the protocol. But I don't think you really saw the economic value get divided. All of it went with the canonical Bitcoin fork, and then there were kind of this array of pretty unsuccessful, hard and soft forks for Bitcoin. Then there's also kind of, if you look at on the dApp layer of forks, there's Multicoin actually came out with a pretty good thesis, which I think is if you are managing risk, you have a protocol that's very difficult to fork. And if you are not managing risk, it's actually pretty easy to fork. So like take Uniswap versus MakerDAO as examples here. Uniswap, you've got liquidity, right? It's open source, V3 is open source. So anyone could just, take that, all of that code and create their own Uniswap. And theoretically, if Uniswap ever started to charge fees, like, there's been a lot of debate this year about the fee switch, then someone else could just fork it and create zero fees, and theoretically they could steal a lot of liquidity. But Maker is different because Maker, the value is you're actually underwriting different forms of collateral. So you're managing risk in a sense there. And you actually, at least till now, right? Maybe AI will eventually figure out how to do this, but right now that means people and competency, and that's a much more difficult thing to fork as a protocol. So on the one hand, I agree with some of that. I think some of the open sourceness of crypto ultimately makes it easy to fork and good for users and bad for investors. But I think if you also look at different pockets of crypto, it's much more difficult to fork and much, in a weird way, less actually open source than it might look at the surface. What do you think about that?
Yeah, that could be. And I think we just have to wait and see that how that plays out. But I guess my response to that generally would be like, you know, show me the crypto success story. Like, if
Yeah.
you look at the top 20 cryptos by market cap and tell me which one of those, other than Ethereum, you would want to invest in, right? Like they do
Mm.
not look like investments. That is like a dog's breakfast of just, to Ponzi-nomics and memes and silly stuff. So, I would like to see a couple of success stories where you could look at it and be like, that's like that looks like a business that I would want to invest in, because I just haven't
Mm.
seen that as of yet.
On the one hand, you've got sort of this ecosystem of true believers in crypto who, look, there is a lot of money on the sidelines. Andreessen basically raised a $4 billion fund right at the top, right? And you also had a number of other funds actually raise a whole bunch of money that they have, I think, yet to deploy. So you could look at this coming year in crypto and say, wow, there's actually a decent amount of dry powder that's sitting on the sidelines and waiting to invest. But also you could say, wow, still big headwinds here. The Fed is going to continue to hike rates, and you know, crypto is extremely interest rate sensitive, and it doesn't really seem like there are going to be any macro tailwinds that are going to pick up crypto as a sector anytime soon. So how are you sort of feeling? I know this is where no one has a crystal ball, but how are you feeling about crypto as a sector moving into the new year?
Um, yeah, I mean, I think on the one hand, I think that's a good thing because I don't think we need another macro based bull market, because those I think are just inherently not very productive. So, we really need a bull market based on utility and new use cases. And hopefully, while money is more scarce, then founders and builders will really have to focus on creating that utility and those use cases. So, my bull case longer term for the sector is that we, stay in this kind of environment for a while. Like if we just turn on a dime and we just rally because the Fed restarts QE, then I don't think that's going to be, productive long term. And it also certainly doesn't seem like that's going to happen. There's the Fed will probably stop raising rates soon, but they'll probably also keep them high for the bulk of the year.
Mm.
And it's really hard to imagine them going from QT to QE on a dime. And is for Bitcoin at least, it's kind of hard to see Bitcoin having any particular great rally until money supply starts going up. So yeah, my guess would be that it's kind of a rocky year for crypto in 23, but long term, I think that would be for the best.
Mm. What about, just as someone with a little bit more gray hair than some of the other folks in crypto, including myself? Uh, I mean, there's a compliment. I mean, there's the most gracious of compliments. One of the sort of narratives that you're starting to see is, oh, well, CeFi was where the big failure happened in crypto right now. And really what we need to see is the larger push to DeFi, which I could see happening. But on the other hand, I could also see, look, people have the memory of a goldfish, right? A lot of times. And right now there's an enormous amount of, uh, you know, negative focus that's being directed at CeFi, but you've had blowups in TradFi, that have basically looked exactly like this, and people forget, and more money comes in, and then it all kind of happens all over again. So if you had to, maybe weigh in on that narrative of this collapse in CeFi is going to lead to greater DeFi adoption, do you think that's necessarily the case, or are we just going to try to rebuild CeFi, build back better, basically, and just run it back and do it all over again?
I think there's definitely some truth to that, because there's evidence of money leaving CeFi and going into DeFi. But I would think that that's going to be a pretty limited trend. Like I can't imagine that I can't imagine that new money is going to go straight from TradFi into DeFi.
Mm-hmm.
I think you need to have a interim step of CeFi for people to get comfortable. I mean, self custody sucks. Like I hate self custody. I don't like having assets in a wallet. That's just terrifying to me. So I mean, like self custody needs to be resolved before people go, genuinely DeFi. And even then, I still can't imagine, people going in en masse straight from TradFi into DeFi. But I think that's fine. Like, I think maybe the industry needs to grow more organically. Like, when I started a bit over a year ago, it seemed like the biggest theme was, when are the institutionals coming, and when are the institutions coming? Everybody wanted the institutions to come in and buy Bitcoin and buy ETH and re-rate all of these crypto tokens. Um, but I think that was the wrong thing to be hoping for. Like, we should have been rooting for all of those institutions to come in and start using DeFi. Just the institutions just coming in and buying crypto was not helpful. It was, in retrospect, it was counterproductive. So I think, the thing we should be rooting for is that, builders, uh, you know build utility and create use cases, and that institutional investors come in and start using the protocols, rather than just buying up all the tokens.
Mm. Do you have a sense of where that might ultimately end up being? So for Bitcoin, really the only thing that you can do there, for better or worse, this might change in the future, but you really only can buy it. It doesn't seem to have much utility in the land of crypto, and you can sort of see that in the amount of transaction fees that Bitcoin generates versus comparable networks like Ethereum. But where do you see institutions actually starting to use some of these crypto protocols? I guess the most obvious area would be DeFi, but I mean, is there another place that you see it intersecting, or where do you see that actual use case um, for institutions coming from?
Yeah, I mean, I guess the two obvious ones would be, real world assets and just, borrowing. So, it's DeFi rates have flipped right now. It's cheaper to borrow on DeFi and more expensive to borrow in TradFi. Whereas it was the opposite for the longest time. So it could be that real world borrowers come to DeFi because it's just cheaper to borrow there.
Mm,
And then the other one would be if we can get real world assets, tokenized and on chain, then that can be a use case for everybody. And I think, like, we never talk about, like JP Morgan coin or whatever, because you can't trade them and you can't do them yourself. But I think there's a case to be made that, institutions will over the next couple of years will get accustomed to, T plus zero settlement and, lending and borrowing intraday and stuff like that, which they can only do on blockchain rails.
mm.
So maybe they'll get comfortable with that, and then they'll see that they can do the same in DeFi and start using those protocols more. But I think it's hard to predict. I think the best bull case for crypto at the moment, I think, is that we're, in the late 1990s, stage of where the internet was, where we're building the infrastructure rails right now, and we don't know what they're going to be used for. We didn't know in 1999. We didn't know that Facebook and WhatsApp and all these things were going to be, was how the internet was going to be used. And I think the bull case for crypto is that, we're building the rails right now, and we don't know how they're going to be used.
I've got a random maybe out of the blue question to ask you here to just end things. But I'm not sure how much you've been paying attention to Elon Musk and his goings on Twitter. What's your opinion on that? I would love to just get your sort of human thought on what you think about him taking over Twitter, and now he's sort of banning some of these journalists, and he just did a vote yesterday. I don't know if you saw, like, should I step down from Twitter? I will abide by the results of this poll. I'm increasingly looking at this, and it's just, from the outside, looks so erratic, and I'm just very curious, what you think about all this.
Yeah, I don't know. I used to be a big fan of Elon Musk because I thought he was like doing huge things to save humanity. Solve climate change with Tesla, and ensure the future of humanity with SpaceX, and fight the robot takeover with that mind machine interface company that he's got.
Neuralink.
So I thought those were all like incredible things. But he does seem to have just completely jumped the shark with Twitter. I don't know. I don't really understand it. I think sometimes in life one thing leads to another. I don't think he ever really intended to buy Twitter. He just said something silly, and then it just got out of control, and all of a sudden he owned Twitter, and now he doesn't know what to do with it. And it wouldn't totally surprise me if like he held a vote on Twitter, like, do you want me to be, the CEO, and people say no, and then he just shuts it down or something. He just gets rid of it and takes it, eats his $30 billion loss or whatever, because, just because he realizes, okay, this is out of control and I made a mistake, and I'm going to cut my losses and go back to building rockets and car batteries and stuff.
I agree with that take. It does look like he's bitten off a little bit more than he can chew. And it is, I mean, people have pointed out, it's very different skill set of building rockets, and Teslas are very manufacturing heavy businesses, and he's proven extremely adept at doing that. And Twitter, social media is a whole other beast. So
well, yeah, one thing that seems, I don't think I've seen anybody comment on this, but that purchase price, it was 54.20, which is a meme, right? Like like I think it seems like he just meant it as a joke. Like, in the very beginning, he meant it as a joke, and now that joke is going to wind up costing him like $30 billion, which is just crazy.
I hope he got a good laugh out of it then.
Yeah.
That's more than I've ever paid for a joke. I'll tell you that. Byron, this has been a ton of fun doing this with you, my friend. Any just closing thoughts on what you want the viewers to go into 2023 with, or commentary on this year, or just show the newsletter? I mean, however you want to end this.
I don't know. I guess I would end it just by saying that I still think crypto is a lot of fun. Like, for as big of a disaster as 2022 is, crypto is still fun and interesting, and much more so than TradFi. So I would just encourage people not to give up on it.
I think that's a good sentiment to end this on. So Byron, this has been a ton of fun, and we'll have to do it again sometime soon.
All right, thanks, Mike.
All right, cheers.